Okay, you guys, we're now going to start Chapter 6, dealing specifically with inventory. And we're going to begin by talking about, we have two inventory cost systems. Now, I believe we mentioned those back in Chapter 5, but we're going to go into them in a little more detail here. Our two cost systems are a perpetual cost system, or perpetual inventory system, and a periodic inventory system. Now, the periodic inventory system was the one that every company used for years and years before scanning equipment came along to make perpetual possible. With a periodic inventory system, it does not account for each purchase and sale of inventory. Instead, net purchases are tracked throughout the year, along with beginning and ending inventory balances from our inventory counts, and then cost of merchandise sold is calculated. So in the ledger, under a periodic system, we would not have the account cost of merchandise sold. Instead, we'd just track purchases throughout the year, and at the end of every year, we'd do an inventory count. So we know what we had in inventory to begin the year. We'd add to that what we purchased. That'd give us cost of inventory available for sale. Then we'd subtract what's left in inventory at the end of the year, and that would give us the cost of what was sold. Now, that periodic system, you guys, is really labor intensive. For instance, I worked at a grocery store that once used one a long time ago, and they had pricing guns, and they'd have to price every item in the store with a sticker. Then when someone checked out, the cashier would ring up that amount. And that worked fine for the sales, but to know how many of an item, say jars of olives, that we had in inventory, someone would have to go look and see how many jars of olives were on the shelf. If it was low on the shelf, they'd go to the back and bring out a box. If there was not a box in the back, it would go on the reorder list. So you can imagine the kind of time that would take somewhere like a grocery store. But we still cover the periodic method. We're going to look at it a lot in this chapter because if you're just starting out, you might not want to invest in that scanning equipment. And it's still a valid method for sure. But with the scanning equipment, what I mean, you know how when you check out at at Ingles or at a gas station, they scan the barcode, right? Well, there's two purposes there. Those people are using a perpetual inventory system, and the two purposes of scanning you out or scanning out items, number one, it rings up the sale, of course, but number two, it takes it out of inventory. So when a company using that perpetual system with scanning equipment, when they get items in, they scan them into inventory, and when you check out, it takes them out of inventory. So under a perpetual system, which is what we used in our problems in Chapter 5, it's the more common one now, probably. Accounts are updated for each purchase and sale of inventory. Merchandise inventory account is increased when inventory is purchased and decreased when inventory is sold. Also, when inventory is sold, we increase the cost of merchandise sold expense account. We actually have that account in the ledger under a perpetual system. And we covered the journal entries required for a merchandising business using a perpetual system. That should read in Chapter 5. So you guys, here in Chapter 6, we're going to look more at the periodic system, because some of you, if you're planning on starting a business, you might start out with this one. Either system, though, we have to do an inventory count every year, even if we use perpetual, and we know how many jars of olives we're supposed to have in inventory. What could happen? We could have some theft. The computer system might not be working properly. So to check the accuracy of our inventory records under a perpetual system, we do an inventory count every year. But we'd have to do the inventory count under a periodic system just to calculate cost of merchandise sold at the end of the year. Here's the thing, you guys. Inventory is really easy under this periodic system if we're always buying inventory at the same price. So let's say we're selling unicycles, for example. If we bought unicycles all year at $100 each, At the end of the year, if we knew we sold 20 and we had 10 unicycles left, well, we'd just say 20 times 100, which gets us 2,000 for cost of merchandise sold. For the 10 that we had left, we'd just say 10 times 100 gets us 1,000 for the unicycles we still have in inventory. No problem if they're purchased throughout the year at the same price. But what do we know about prices, you guys? Throughout the year, they normally increase, right? So, if we purchase some unicycles at $100, some at $120, and some at $150, when we got to the end of the year, if we've sold 20 unicycles and we have 10 left, we have to be able to assign a cost to the 20 that were sold and to the 10 left in inventory. And that gets a little trickier if they were purchased throughout the year at different prices. So you guys, we're paying different prices for inventory throughout the year. We have three ways of assigning a cost to ending inventory and assigning a cost to cost of merchandise sold under this periodic system. We have three inventory cost flow assumptions. First one's called the FIFO method, which is an acronym for first in, first out, meaning the first inventory purchased would be the first ones considered to be sold. So on our unicycle example, the first 20 we purchased that year would be in cost of merchandise sold. The last 10 we purchased that year would be in ending inventory. Now this doesn't mean literally, you guys. We don't, if we purchase some unicycles in June and some in November, and we see someone buying one for a Christmas present, and they pick one up that we bought in November rather than one left from the June purchase, we don't stop them and say, hey, we use first in, first out. You're going to have to go back and pick up the unicycle we purchased in June rather than the one we purchased in November. These are not literal. This doesn't mean literally. It doesn't mean that literally the first ones we purchased were the first ones that were sold. It's just we're at the end of the year. We have sold 20 unicycles, we have 10 left in inventory, and we want to assign a cost to both groups. First in, first out is just a method for assigning a cost to the items that were sold, which would be our cost of merchandise sold number, and to the items left in inventory, which would be our ending inventory balance. Okay, we could also use last in, first out, meaning the last ones or most recent ones purchased would be the ones we would include in cost of merchandise sold, and the ones we purchased back at the beginning of the year would be the prices we would assign to our ending inventory balance. And the third one is average cost method. It just takes an average of the prices that we paid throughout the year and assigns that to the ones sold and to the ones left in inventory. This might seem a little confusing in first going through it, but the problems are really very simple.